Okay, welcome to our final lecture on for ACC 401 taxation of individuals, Chapter 13, retirement savings and deferred compensation. I have a little experience with both of these. So, it's always nice to read the backstory they give you at the beginning of the chapter, and you should look at the future to provide for yourself. Now, the thing we established early on this semester is the tax code. Congress uses a tax code for basically two functions: to raise revenues to pay for the functions of government, and the other is to encourage certain behavior or discourage certain behavior among the citizenry. Well, the provision for one's retirement or golden years is something that is desirable. The government would rather have you do well during life, save some money, give you some incentives to save money, so when you're retired, you can take care of yourself with your own assets and you won't end up on welfare, which would be a cost to them. If you have a nice retirement, the retirement can be raising revenues for them. So it's a double win for them and it's a win for yourself. You don't have to, the benefits they give are subsistence level, and who wants to live at subsistence level? So they start off here, employer provided qualified plans. Now for the employer, the contributions they make are deductible. Okay. They are two types of plans out there called a defined benefit plan and a defined contribution plan. The defined benefit plan, I have one from my 35 plus years with the Commonwealth of Pennsylvania, and it has a formula based on your highest 3 years of salary times the number of years you worked. Once you're vested, you hit these criteria, and it's a formula that determines how much your pension will be. Defined benefit. The benefit the employee will get is defined by some type of formula. Mine was number of years of service, or the average salary, your highest 3 years average salary times the number of years you work times 2.5%. So if you work 40 years, you get 100% of your salary. I worked 35, I'm getting about 70% of what I was earning in salary prior to my retirement. The defined benefit plan is falling out of favor with employers because it puts the burden of risk on them as opposed to the individual. A defined contribution plan is the opposite. It defines how much is going to be contributed on behalf of the employee, and whatever it amounts to when that employee retires, that's what they get. Okay? So let's repeat those definitions a little bit clearer. The defined benefit plan is an employer-provided plan that spells out the specific benefit employees will receive upon their retirement. A defined contribution plan specifies the maximum annual contribution employers make, and sometimes employees can contribute to that. Here at the university, I have an amount taken out of my pay, and then I can, by definition, a minimum amount, I think it's 5.5 or 6.5%, and then I can have additional extra monies taken out, and the school will match it, and they'll match it up to, 8.5 or 9%. They suspended that for a while, but then they reinstated it. We'll talk more about the mechanics of these things, of how it affects your pay as you're working. Oh, my phone is going off. I'll be right back. All right, sorry for the interruption. Now, defined benefit plans, they can be, both plans, defined benefit, defined contribution plans, can be what we call participatory or non-participatory. Participatory means the employee contributes a bit and as the employer contributes. Non-participatory is only the employer contributes to the plan. The employee doesn't make any contribution. When I worked for the Commonwealth, it was a participatory plan. They put in so much, and they took every paycheck, they took 5.5% out of my pay, my gross pay. Now, the amount that is taken out of the employee's contribution is tax deferred. So if I made $2,000 a week and I had $500 of my money going into the retirement plan and no other deductions, I'd have a take-home pay of $1,500. My W-2 would show, wages of, what did I say, $104,000 a year, but my taxable would have been, let's see, 500 would be 26,000 less, would be 26, 84, 88,000 would be my taxable earnings on my W-2, because that contribution, the government, Congress says, hey, that's a good thing. Encourage people to save for their retirement, and we'll tax them later on when they take that retirement out. So it's tax deferred. Okay. Let's see. Okay, there is a compensation limit. It varies by year, so be aware of that. Don't pay attention to the numbers. Annual compensation limitation was $275,000 for 2018, $280 for 2019, $285 for 2020, and $290 for 2021. So it's probably going to be $295 or $300 for 2022 and 2023. Will be even higher. Okay. I'll give an example there, talking about those limitations. Investing. Investing is a term used to describe the requirements an employee must meet in order to qualify for their pension benefits. Some companies have 5 years, 7 years, some have 10, some have 2 years. And if you leave the company, if you're vested and you leave the company, you can move that to a self-directed retirement plan and defer paying taxes on it. Or you have the option of taking it, cashing in, paying the penalties on it for early distribution. The regular tax plus a 10% surcharge tax. Distributions. Whenever benefits have been vested, the employee has the right to it. Okay. Distributions from defined benefit plans are subject to early distribution requirements and to minimum distribution requirements. They just raised that. I think it's now 72 or 72 and a half. You have to start taking it out and start paying the tax on it. However, because defined benefit plans typically don't permit payout arrangements that would trigger the early distribution or minimum distribution penalties, the penalties are of greater concern to participants in defined contribution plans. And key fact, employer, non-employee, bears the investment risk of the plan. So if it falls short of the actuarial number, target number, the employer has to make it up under a defined benefit plan. When I worked for the state, when the stock market was going good, every payday I would get an earnings statement, and it would show how much of my pay they took out. It was 5%, and then later on they changed it to 6.5%. And that's my money going into my retirement fund, and the state would put a contribution in too. Their contribution varied depending on how the plan's investments did. There were some years where the state did not put any money in to my retirement account because the earnings on the account, it was equal to or exceeded their minimum required contribution. There were other years when they had to put in whatever it was, the required minimum contribution. And if the retirement fund did not do well, if the stock market was down or whatever they had invested in, they would have to pay more than the minimum required contribution to keep the fund solvent. So that's why defined benefit plans are falling out of favor, because it puts the risk on the employer when the plan assets do not generate enough earnings, and the burden falls on the employer. Defined contribution plans. The employer specifies the amount it will contribute to the employee's retirement account, not the amount the employee will receive at retirement. So the risk is borne by the employee, not the employer. Employers typically match the employee's contribution. Sometimes they only do a percentage of it, 75, 80%. Sometimes they will contribute over and above what the employee does, an overmatch. So they can match it, undermatch it, or overmatch it. Employee chooses the funds, how the funds are invested, depending on their risk tolerance. Employee matching. Employers typically contribute a certain defined contribution, and based on a fixed formula, or based on profits, or maybe at the employer's discretion. Yeah. In contrast, employees contribute to a 401k plan. The employers must match the employee's contribution. And different employers have different percentages and different plans. The match is kind of nice. If you ever get a job where they match, try to max out, because that's more money going into your retirement fund, and it's beneficial. You're doubling your money. If they match it, you put in 1,000, they put in 1,000. I'd rather have 2,000 than 1,000. I think most people would. Limits. Traditional defined contribution plans. The lesser of 58,000. 64,500 for employees 50 years of age or older. That's called a catch-up provision. You'll see that a lot in retirement savings and tax situations. Or 100% of the employee's annual compensation. Okay. So they better have other means of income if they're putting all their pay into the defined contribution plan. For 2021, the 2021 employees contribute limit to 401k of 19,500. Or 26,000 if the employee is over 50 years old. Catch-up provision. That gives you a little bit of a break, but it's really it helps, but it doesn't make up for the years you couldn't put the much. The earlier you start saving, the better, because of the compounding. Employee contributions are limited, like it said. 19,500, 26,000 if you're over age 50 for 401s. Investing, we already talked about that. After-tax cost of contributions to traditional non-Roth defined contribution plans. Employees must vest or be entitled to employer contributions and earnings on those contributions using the 3-year cliff vesting or the 6-year graded vesting. Employee contributions before tax amounts. That means it comes out of your paycheck and it's not subject to federal income tax. You will pay the federal income tax when you retire and start taking distributions. So it's a tax-free contribution. The after-tax cost is before tax contribution minus the tax savings from the contribution. So it's kind of a neat deal that you can save some money tax-wise up front, but you don't know what the tax rates are going to be when you retire. It's entirely a crapshoot. Distributions from traditional defined contribution plans, age 59 and a half, or age 55 and have separated from service, retired. Okay, so if you take a distribution before age 59 and a half, which is usually called normal retirement age, or you have retired, you're 55 years old and you've separated from service, retired or let go by the employer, you're subject to a 10% non-deductible penalty on the early distribution if you take it out before then. They also surcharge you if you don't take it out by age 72 now. Okay, traditional distributions from defined contribution plans are taxed at the taxpayer's marginal rate, ordinary income rate. Okay, you have the 10% surcharge, surtax for early distribution, 59 and a half, before age 59 and a half, or before age 55 if you retire. I retired at age 57 or a little over 57, but I had over 35 years in and I had reached normal retirement these 35 years. So I started taking my retirement, and I wasn't subject to the early distribution, even though I was under age 59 and a half. Required distributions must be received by April 1 of the year later. And this is, age 72. This, I guess, is the new one, age 72. They may have made it 72 and a half now. Or the year after the year in which the employee retires. Okay. April 1st of the year after the year in which the taxpayer hits age 72, or the year after the year in which the employee retires. They do that so the tax they forego when you were making the contributions, they want to make sure you take a distribution. I think there's a hitch in the law that says you don't have to take the distribution, but you will be taxed as if you did take the minimum distribution. They used to have that. I don't know if it's still in effect. I don't see much on it in literature anymore. You must receive a required minimum distribution each year after retirement year, and 50% penalty to the extent required minimum distributions are not made. Taxpayers who fail to receive the required minimum distribution are also penalized. The year in which the employee reaches 72, or the year in which they retire. They give you a table there, Exhibit 13.3, of the distribution period based on your life expectancy, depending on the age and the percentage of what you have to take out. After-tax rate of return. They do a little comparison there in Exhibit. Things pop up. Exhibit 13.4, they do a comparison between defined benefit and defined contribution plans. It's kind of interesting. Roth plans. Roth was a senator, I believe, maybe a representative, that came up with the Roth IRA, but also did some other work. This is not the Roth IRA. This is a Roth 401k. Employees, but not employers, may contribute. So this is funded by the individual employee. Employers only contribute to traditional 401ks, not a Roth 401k. Contributions are not deductible. Same contribution limits as for traditional 401k plans. And again, these numbers will vary each year. They're increased for index for inflation. Key facts. Qualified distributions are not taxable. Wow. Tax exempt, not tax deferred, tax exempt. But the account must be open for 5 years before distribution, and the employee must be at least age 59 and a half at the time of distribution. Now, again, this is not pre-tax dollars being put into a Roth 401k. It is after-tax dollars. So they've already been taxed. They're giving you a little break that the earnings on it are not subject to taxation. They have the non-qualified distributions there, of which 3 of them are. And they compare traditional defined contribution plans and Roth 401ks. Exhibit 13.5 does a nice summary of it. Okay. So the big thing is that only the employee can fund it. The employer does not. Tax consequence to the employer. Contributions deductible when paid. And not applicable to the 401k plan. Traditional 401 contributions are deductible. Contributions are not deductible. So there are some restrictions on the Roth. And then the distributions. The big one is the Roth 401k not taxed. Who knows what the tax rates are going to be when they're retired, but you can do a guess if depending on what you think your income is going to be, what your bracket will be, and that could very well result in a bigger return than the 3, 4, 5% you're getting in your whatever investment you have it invested in. Okay, no penalties for the Roth 401k. So there's a lot of advantages for Roth. Again, Congress is trying to encourage people to save on their own. Some of that might be fear that the Social Security system is going to go bankrupt someday unless they change things. Non-qualified deferred compensation plans. That's compensation provided for under a non-qualified allows employees to defer compensation to a future period. Towards the end of my career with the Commonwealth of Pennsylvania, they have a deferred compensation plan. I took advantage of it, and it would be the same thing. Anything I put into it was reducing my W-2 earnings. So my gross earnings were whatever they were. My taxable earnings were less my contribution to the state retirement, less my contribution to the deferred compensation plan. Then it's taxable upon distribution. Key facts, you want to look for the employee considerations. Employee is taxed when payment is received. Distribution. Employees generally select investments. So you put in stocks, bonds, or whatever. Real estate investment trusts. Gold. I guess you can put it in crypto if you feel risky and can take the risk. Just as for traditional deferred compensation plans, after-tax return depends on the before-tax rate of returns, marginal tax rate at the time of retirement deferral, and the marginal tax rate at the time of distribution. Okay, and again, you're working with the future. You got unknown quantities there. Rates can go up, can go down. Payment is not guaranteed. If the employer doesn't pay, the employee becomes an unsecured creditor. That's regular 401k. That's a nice thing about the Roth 401k. It's yours. It's not in the employer's hands, or usually the employer funds them, and they have a trustee or a fiduciary that has custody of the funds. If it's a Roth, it's yours. Okay, you don't have it in your account, but you have to establish with an investment advisor somewhere to invest it. Employer considerations, again, that would be for the non-qualified deferred comp plans. They deduct it when paid to the employee, not required to fund it. It's all funded entirely 100% by the employee and used to accomplish compensation objectives or other over the contribution limits for other plans. So there's a lot of ways you can fund your retirement, and the more you have, the better. I've been fortunate in life. My wife always had a good job. I had a good job. We had retirement. Both had retirements. Both have Social Security. We both took advantage of deferred compensation plans that were made available to us. And we also, way back when, we put some money in our individual retirement accounts. Later on, towards our career, when you're making more money, we were over the limits. We could have put it in, but there would be no advantage to do so. So I just made the investments outside the IRA account. Qualified plans versus non-qualified are summarized and compared in Exhibit 13.6. Please spend some time reviewing that. And individually modified qualified retirement plans. Okay. The IRA account. It's a tax advantage account in which individuals who have earned income can save for retirement. Actually, you can actually put away for a non-working spouse. You're allowed to put some money into an IRA. Individual retirement accounts, IRA. Now, typically, right now, the IRA is what President Biden calls the Inflation Reduction Act. Don't confuse the two. They are two same. What are the acronyms? Different things entirely. So there's traditional IRAs and Roth IRAs. A traditional IRA allows the employee, the individual making the contribution, to take a deduction on their tax return for their contribution. Now they phase that out over a certain income level. Okay. Right now we can put $6,000 of earned income away per year for 2021. If you're over age 50, they allow an extra $1,000 for what they call the catch-up provision. Catch-up, C-A-T-C, not ketchup, not the Heinz tomato sauce. If the taxpayer participates in an employer-provided pension plan, the deduction limit is phased out for single taxpayers with modified adjusted gross income between $66,000 and $76,000. For married couples, it's $105,000 to $125,000. So again, they didn't used to have that limitation. Anybody could put money into an IRA account, and after a while, it got so popular because it's such a good idea. They were losing revenues, and they figured, hey, the higher level compensated individuals really don't need the benefit, and that's why they phased it out. Okay. Again, individuals on that up above that limit, they can do it, but they don't get the deductibility. In fact, the deductibility phases out in that window between 66 and 76 for single taxpayers, and 105 to 125,000 for married filing joint. Special rules if one spouse is covered by a plan and the other is not. Again, trying to be equitable there. And there you see it. When these things started out, back in the 1980s, remained that for a long period of time. Then they upped it to 3,500, then 5,000 or 5,500, and now it's at 6. So as inflation eats away and the purchasing power of a dollar, they're going to, I would think, continue to raise those deduction limits. They should also start raising the phase-out window. It may be restricted depending on factors such as being covered by an employee-sponsored retirement plan, your filing status, the amount of earned income, your modified adjusted gross income, and we've seen some of those things already. They give you an example there, and let's see. They just show you how the phase-out works there. Married taxpayers can make deductible contributions to separate IRAs. Yes, my wife has hers and I have mine, and they're old. And they actually started out with the traditional, and then a while in, they made what they call the Roth IRA available. And I was able to convert mine by paying the tax because I had gotten deductions when I funded them. So when I converted them, I had to pay the tax on them, but they allowed you to do that, averaging that amount over 4 years, so you wouldn't get killed by going and jumping up several brackets. It did raise me up several brackets, but it didn't. They softened the blow a little bit by allowing you to average it over 4 years. All right, all the little nuances here are listed. Contribution to the lesser earning spouse IRA is called a spousal IRA. The spouse is an active party. Married taxpayers who file separately may make deductible contributions, but again, they would be $6,000, and they would be subject to the $66,000 to $76,000 phase-out window for the deductibility. Okay. The deduction is phase out there. If the taxpayer does not participate in an employer sponsored plan, the deduction limit is raised to 198 to 208. And when you pull the money out, it's taxed as ordinary income. The thing with the Roth, why I converted the Roth is, again, not knowing what tax rates are going to be 20, 30 years down the road. The Roth are tax-free. The distributions are tax-free, and I figured that would be a risk worth taking because I figured there's going to be some types of tax rate. Don't know what it's going to be. And Roths have some other things where you don't have, I believe you don't have to take distributions, so you can leave it in your estate to whomever you want. So, again, it's not the rules that are tough, it's the exceptions to the rules, actually the exceptions to the exceptions. Non-deductible contributions. Okay, if you're over the phase-out window, you can still put money away, except you won't get a tax benefit for it. And you may as well do it because you're saving. The earnings in the IRA accumulate tax deferred. You don't pay tax each year as the dividends and interest accumulate, and or the appreciation of the stock price. You will pay that when you start withdrawing it, when you make the distributions. The exception is contributing to a spousal IRA. The taxpayer must have earned income in order to make a non-deductible contribution. Exception is with the spouse, a spouse with no earnings. Okay. The earnings grow tax deferred until the taxpayer receives a distribution. The taxpayer is taxed on the earnings generated by the non-deductible contribution, but not on the non-deductible contribution. Okay, so that can be tricky if you do fund it. You got to keep track, good records. Partial distributions, you got to prorate them. Okay. What is it? Roth IRAs. As an alternative to traditional IRAs, taxpayer meeting certain requirements can contribute to a Roth IRA. Contributions are non-deductible, so you get no immediate tax break. They're made with after-tax dollars, not pre-tax dollars, like traditionals are. The same contribution limits as a traditional IRA, but for 2021, contribution phases out between $125,000 and $140,000 for unmarried taxpayers, and between $198,000 and $208,000 for married taxpayers filing jointly. So the phase-out window is significantly higher. To qualify, an account must be open for at least 5 years before distribution, and distribution must be made after the taxpayer reaches age 59 and a half. So you do that, before that, you're subject to the early distribution penalty. But again, the distributions are tax-free. Tax-free is way, way preferable to tax-deferred. Tax-deferred means you're going to pay tax on it at some point in the future. Tax-free means you take it out and you don't pay tax on it. What would you rather do? If you're in the 30% bracket, for every $100 you take out, you're only going to end up with 70. If you're tax-free, you take $100 out, you get the $100. You don't have to pay tax on it. Non-qualified distributions, taxed at ordinary rates, subject to the 10% penalty. And again, that would be prior to your age 59 and a half. Distributions come first from the contributions and then from the earnings. Okay, so that's another benefit of doing it. Contributions, the same as traditional IRAs, and they give you the repeat the requirements down. Distribution made on or after taxpayer reaches age 59 and a half. Distribution is to a beneficiary on or after the death of the taxpayer. Distribution is attributed to the taxpayer being disabled. Distribution is used to pay qualified acquisition costs for first-time home buyers. Okay, that is if you do it. A qualified distribution is not taxable, and again, that could be before age 59 and a half for those 4 exceptions. All other distributions are considered non-qualified. So you want it to be qualified so you don't pay any tax on it. Again, tax exemption is better than tax deferral. Converting a traditional IRA to a Roth, well, I did that. It's rollover. Again, you're going to pay tax on the amount that you previously got a deduction for because you're not entitled to it now because when you pull it out, it's going to be tax free. 60 days you can take it out and do something with it. I don't advise that, and then put it into the Roth. Okay. Within 60 days when you take it out of the traditional IRA. I had one client that did that and missed the window. They ended up getting burned because they had to pay tax on not only tax on the money, but they had to pay the penalty for premature. Now they were over 59 and a half, so they didn't have to pay the penalty on it. Take that back. If they were under 59 and a half, they don't only have to pay tax on it, they'd have to pay the early distribution penalty. Exhibit 13.7 does a comparison between the traditional individual retirement account and the Roth individual retirement account. You can see the contributions are the same, but the deductibility does not exist for the Roth. For the traditional, depending on your filing status and your modified adjusted gross income, you can deduct up to the max and then it gets phased out. Distributions are not taxed for loss. For traditional, they're taxed at ordinary income. And you can look at the other ones there. Self-employed retirement accounts. These are really good. The limits are pretty high up there. Self-employed individuals. SEP IRA or self-employed 401ks. Simplified SEP, simplified employee pension. Look what you can do there on page 1328, 29, whatever it is. Simplified, you can contribute the lesser of $58,000 or 20% of your Schedule C net income after reducing Schedule C net income by the deduction for the employee's portion of self-employment taxes. That's your Social Security. Okay. $58,000 a year. Think about it. In 20 years, you'll have, even if it doesn't earn anything, you'll have over $1 million. 10 years would be 580. So probably around 8 years, 9 years. If you're having a good return, you could probably get to $1 million in about six or 7 years. So there's a advantage of being self-employed. Again, how many people that are self-employed have enough earning to contribute $58,000 a year and still have some money to live on? Okay, so again, how many people are going to be affected by that? Not a whole lot of the population. That tells me some group, a lobby group, got that put in there for a very few number of taxpayers. Okay. Individual 401k plans, the lesser 58,000, reduced by their portion of self-employment plus 19,500. Taxpayers who are at least 50 years old at the end of the year may contribute an extra 6,500. Will be 64,500 versus 58,000. I guess every little bit helps. And again, contribution cannot exceed the Schedule C net income. And there's things you can do there to manipulate your Schedule C income. If you want to put in a little more, if that's going to limit you, you just have some deductions you don't take. You raise your income, your taxable income, pay some income tax, but you get to sock away a lot of money for your retirement. It's one strategy to use. Let me give you a couple examples there. Non-tax considerations. You can look at those. Savers credit, you get a credit for contributing to a qualified plan. Maximum credit's $1,000. Again, they want to encourage people to take advantage of these things in the tax code because it's a desirable thing. You have people retired and be able to have a nice, comfortable retirement and avoid having to live on the public dole, collecting welfare. So they give you a percentage of savers credit depending on your AGI, and filing status. Again, they phase things out. Again, they want to make these things widely available, but they want to not look like they're favoring highly compensated individuals, because those people they're going to have enough. They're going to have investments outside retirement plans to live on. They're going to have good retirements. They're going to have a whole bunch of things, and there's so much pressure on Congress to make sure the rich pay their fair share. And then if you give them the tax break that you're giving to the medium income earner and the low income earner, it looks like it's unfair. I don't know about that. I think the rules ought to be the same for everybody, regardless of your income, and maybe go the other way. Make it better for the higher income individuals to give people an incentive to earn more, to work harder, and possibly take a part-time second job to do that. You have all these problems in the country now with what we have, and some of this stuff is counterproductive. Uh, I don't know if you've watched the news, but Oregon or Washington State just passed a law that if a homeless person is living outside your house on the sidewalk on a tent, you can't have them removed. You can't remove them or have them removed. And I look at that, what the heck are they thinking? That's only going to exacerbate the problem. It's going to make it worse, not solve it, not clean it up. But again, that's West Coast people and West Coast thinking, I guess. All right, enough of my pontificating. Now at the conclusion of chapter 13, a little short, sweet chapter, but a very important one. And if anything, it should encourage you as soon as you are able to start putting money. I tell all my classes, or just about all my classes, I ask the question, when is the best time to start investing? And they'll say, now. I said, no, yesterday was the best time to start investing. Today is the second best time. The third best time is tomorrow. The earlier it goes. I'm going to stop the tape. I'm going to dig out, see if I can find a paper from my one other course that'll really open your eyes. Hopefully I can find it. Be right back. Okay, I'm back. I took a little digging through my papers that I was cleaning out. Here's an example from the MBA 507 course that I teach in the master's program. Um, Let me find the problem here. Chapter 5. Okay, here it is. Selma and Patty Bouvier are twins and both work at the DMV. They decide to save for retirement, which is 35 years away. They both receive an 8% return on their investment over the next 35 years. Selma invests $2,000 per year at the end of each year for the first 10 years of the 35-year period, for a total of $20,000. Patty doesn't start saving until the 11th year, and then saves $2,000 per year each year for the remaining 25 years, for a total of $50,000 saved. How much will each of them earn? Will have in the retirement account? Well, here's the paperwork here. Even though Selma only puts in $20,000, after 10 years with an 8% return, that grows to $28,973, and then continues to get an 8% return for the next 25 years, which turns into $198,421, even though she only put in $20,000 in years 1 through 10. Her sister Patty waits 10 years and then puts in $2,000 a year for 25 years, or a total of $50,000, and that will grow to $146,212. So even though Patty only puts in 20, she started 10 years earlier, so the compounding of interest gives her an additional $52,000. Amazing. And again, most of America is illiterate. Here's an IRA contribution table. I don't know if I sent this out to you or not. And this is at the old $5,500 a year. And I have two columns here, one for a 6% return. I'm sorry, 8% return and a 6% return on your money. And the dark boxes are roughly when the amount in the fund doubles. If you look at the last doubling, you make more money than you did in all the previous doublings. So if you put $5,500 a year in at the beginning of the year, for 40 years, you will have put in $220,000. If you get an 8% return on your money, that will grow into $1,538,795.72, which will give you earnings on that at 8% in excess of $110,000 a year. So you don't even have to touch the principal amount. You can just live off the interest or dividends it's generating. If you only manage to get a 6% return on your money, you'll have $902,000, $98,000 short of $1 million. There it is right there in black and white. The time value of money. Start saving earlier. Investments, and again, this is a tax course, but from an investment standpoint, trying to maximize your wealth over your lifetime, it has two things factor into it. The rate of return you get on the investments and the period of time you have the investments are earning that money. You can see in the later years, the investments, the contribution and the investment are $100,000 a year. That is, you're putting in $5,500, the plan is making $105. Let your money, you work hard for your money, put it away early and save it for retirement, make it work hard for you. So that's it for Accounting 101, except for the final exam, which, again, I try to get these things out to you earlier in the week, but I've just been so busy with papers and exams and other things in the semester items. Thank you for all the work you've done, and do good on the next exam, and you will get a nice grade.